Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Hello and welcome. Now, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on my charts. This was all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. Okay, so first a quick look once again at my longer term monthly charts, as there has been some very interesting actions taking place there. So we can see that the market, since as far back as the lows seen in August this year till October this year, built a sideways action. I noticed this action 40 weeks ago, and I'll expand on that shortly, but I just wished you to see that this sideways action had a breach on the upside in October this year, and the market has been trying to stabilize over this now sideways action. Originally between about the 2019 today uptrend, it's currently at 979, up to the topside congestion, the 1105.5 area. As recently as last week, we seem to have established a basing action around a triple bottom formed over August 2024 to August 2025. And this is where a caution I gave over the last few weeks comes in, and I quote, "I once again, as I have done for quite a few weeks now, feel obliged to caution you on the possibility of a false break higher." End of quote. Now, however, I tempered that statement with the following, and I quote, "But as even now this seems unlikely, then we have a primary target on this longer term chart up in the 1189 area, with a secondary harder to reach target up in the 1244 area." End of quote. Well, the unlikely seems to be happening as this morning, as this morning is so far set, this market is so far set for only a few trading sessions left to make a combined monthly bearish engulfing pattern and bearish opening black Mariposa. This is yet to be confirmed, but if that is what it looks like right now, and as I said, we only have a few sessions left to change that idea. This would mean that the market may be back within the original sideways action, with all the implications that may have. Back now to my daily charts, and you can see that same up over the market just underneath the top of the daily chart, that same trend line up over there. Now, in addition to this bright red neckline, some 40 weeks ago, I highlighted this on my daily chart, a bright pink July 24 to October 25 rectangle pattern, which you can still see currently at 979.75 to 1106. This is the outline of that basing action I spoke about on my earlier monthly chart. This pattern had worked until late October, when prices punched up through the upper pink trend line, taking most of November to stabilize over it. Now, 3 weeks ago, prompted by the bullish action on Winnipeg canola the previous week, I drew a dark blue mid-December 24 to early August 25 bullish Andrews pitchfork. What is noteworthy about this pitchfork is the effect the dark blue middle tine above, which is currently at 1162, had on the market since the start of November. It was a cap, a pierced cap, but still a cap, and one that caused the market to develop into perhaps the most interesting short-term pattern here. You see, we have since late October formed a head and shoulders top. 2 weeks ago I said about this pattern, I quote, "This is not fully justified as prices have only yesterday dipped below the bright green neckline, and that's currently at 1155.5. Thus I cannot lay out targets below as yet, but I can set out some potentials. Hence a primary potential will be down in the 1107 zone, just around where the bright pink broken upper trend line lives. And whilst the secondary harder to reach potential will be down in the 1080 zone. Please know that these are just potentials at this time, as we sit with only one close below the bright green neckline, and there is still a significant chance for a false break on the downside." End of quote. Last week I said, and I quote, "This pattern is fully justified. with the market already reaching the primary potential, now target at 1107, and the secondary harder to reach target X1, the harder to reach potential at 1080 becomes a target X. This week, and that's the end of the quote. Now, this week, on the Monday, prices reached the secondary target X. There's also something else I spoke about last week which I would like to discuss, and I quote from about 2 weeks ago. One final feature, and this is right now in development. We're set up to make this week a weekly key reversal. Thus, if we close tomorrow night either over 1146 or under 1134, then we would be on. Anything in between will have a lesser outside weak pattern. At the moment, we are looking at a weekly key reversal down, which would tie in with the earlier head and shoulders pattern. But please remember, we still have Friday to go. End of quote. Well, we have since then formed a weekly key reversal down 2 weeks ago, and that in part is an explanation for the subsequent move lower we saw last week and also this week. Last week, I hoped that 3 things might erode the immediate bearishness. They were: 1, the old pink breached upper base trend line; 2, the 50% Fibonacci line of the May to August 24 move at 1098; and 3, the rising green short medium moving average, currently 1094 3/4. They did not. And in anticipation of this, I added last week, and I quote, if it doesn't, then we have little support until the 50% Fibonacci line of the August to date move at 1067 1/4, and the nearby change gap at 1063 to 1070 1/4. End of quote. Well, this is where we are now, and I would add to the mix the rising mauve medium moving average, currently at 1064. Now, if these give way, which is possible, then we have nothing until the long moving average, currently at 1049.5, and the dark blue lower time, which is currently 1043 1/4. What is interesting about these two is these supports below is that they are in the midst of congestion from earlier this year, between about 1061 down to 1020 on the wide, and would likely be a suitable resting point should the 50% Fibonacci line at 1067 1/4 fail to hold, which it might. Chicago soybean meal. Okay, so in 2025 so far, we had a pair of descending wedge patterns plus a reverse head and shoulders pattern that have broken on the upside, resulting in a significant move higher in mid-autumn, reaching topside targets and becoming something that had been trying to alter the whole strategic basis of this market, a point which I will discuss later on. In the immediate past, the market had peaked up over the significant resistance of the dark blue trendline extension to the July to September 2021 descending triangle pattern. It's currently at 314.30, and started stabilizing over it in late October and early November. It looked initially as if it was possibly forming a base, but then no. Meanwhile, the top side had resistance, as I stated 6 weeks ago, and I quote, 2 others that need to be noted. The first is easy enough. It is the high for 2025 at 326.60. Interesting, around there we have some other resistances, notably the 50% Fibonacci line for the May 24 to July 25 move at 326.20, plus some congestion at 326.90. So that altogether, they make an overhead congestion area between 326.20 to 326.90. Then above this is the 61.8% absolute Fibonacci line at 336.30, and I will leave it at that. End of quote. Up at these levels, we indeed found resistance, though the peak 4 weeks ago was short of testing that 61.8% absolute Fibonacci line. The next question following this was simple, and I asked it 4 weeks ago, and I quote, the next question is simple. Do these resistances form a top or a bullish halfway hesitation? The answer is not obvious yet, though we did have a horn top which failed, and then a higher 2-day bearish tweezer top pattern, from which we saw the outcome in a fallback below the interesting 326.20 to 326.90 congestion. And that's the end of the quote. Well, the question was answered. We had a top as we formed a late October to early December head and shoulders top. Early 2 weeks ago, prices broke down through the bright red neckline, currently at 322.20, and carried on lower until midweek last week. 2 weeks ago, I said the following, and I quote, thus, I've laid out some possible targets below for this pattern of a primary target X down in the 308.70 zone and a secondary hard to reach target at 2980 zone, close to the 50% Fibonacci line for the whole of 2025 so far at 298 even, and at the start of the big congestion from April to August 2020, end of quote. 2 weeks ago, the market reached target X, and then last week prices reached down to target X1, and as I said last week, and I quote, "We have seemingly started to halt and even consider pulling back up, as not only do we have that congestion mentioned between April to August 2020, but we also have the rising green short medium moving average, currently at 305.30, and the 50% Fibonacci for the whole of 2025 so far at 298 even. I'm now watching carefully to see if this is just a pause before moving lower or as if the start of a basing action." End of quote. Well, it all looked like the basing action until the pattern made this past Tuesday a combined shooting star pattern, type 1 bearish, and a bearish gravestone doji, and prices dropped back down, back below the green short medium moving average, which is where we are now. We have some significant congestion below, between 282 and 300, dating from April to August 2020, plus the 50% Fibonacci line for 2025, the one I previously mentioned at 298 even, and a gap from late October between 296.80 to 297.30. Is this enough to hold it? I'm not sure, but it's enough to make the market think about holding. As further down we have the medium moving average, currently at 294.40, and the long moving average, currently at 293.30. Plus the 50% Fibonacci line, as I say, for 298, all the way down to the long moving average. That is where we can see prices hold in that zone, between that 50% Fibonacci line down to that long moving average. Finally, this commentary would not be complete without my discussing a portion of my commentary which I have repeated for 132 weeks. So for over 2.5 years. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, "And I only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since," end of quote. I've also added ever since, and I quote, "There's only one thing you take away from any of my musings, let it have been those words," end of quote. For over 2.5 years, the shadow of that pattern has darkened the skyline of this market. During October, it looked like we might be seeing the first signs of the light of dawn stretching through the darkness. I'm sorry if I sound vaguely poetical, but this bearish longer-term pattern has been such a cornerstone and companion to this market for so long, it's hard to imagine a time when it may end, but end it must. However, with this construction of a head and shoulders top pattern, it looks like it has been delayed. Chicago soybean oil. 5 weeks ago, I said, and I quote, "For all the activity in the soybean complex, it was time I finessed this daily chart to show a better and clearer view of what is going on. Thus, the key pattern here is the newly expanded, sorry for the pun, the newly expanded dark blue April to date ascending expanding wedge pattern. Currently 52.11 to up off the top of my daily chart." And that's the end of the quote. Specifically, this pattern, specifically the dark blue lower trend line, has until recently acted more as an attractor than an ascending expanding wedge pattern. Now, I also added 5 weeks ago about this market and ever since, and I quote, what I can say is twofold. Firstly, in the immediate market, please pay attention to the overhead mauve medium moving average. It's currently at 51.34, as this capped prices in October. And also the gold long moving average below, currently at 50.41, which whilst it is not perfect, has helped bolster the second thing to watch for, and that is both the 50% overhead Fibonacci line at 53.59 of the July 23 to August 24 move, and the 38.2% Fibonacci line below at 48.95. And that's of the significant March 20 to April 22 move. These two features seem to be better at defining the market right now. End of quote. In between these two features, the market grew since mid-October. A new pattern, a bright red mid-October to mid-December ascending wedge pattern, currently 51.03 to 53.42. And it utilizes the dark blue lower trend line as a center line, like that on an arrow or a spear. Late last week, the market prices punched down through the bright red lower trend line, as well as the gold long moving average, and all the way down to what I suspected was the key support below, which was that 38.2% Fibonacci line at 48.95, which was pierced, but which we have seen hold up the market so far on a closing basis. Nevertheless, despite the support, I feel obliged to lay out targets below for this ascending wedge pattern. Thus, a primary target would be down in the 49.37 zone, a target which we have already achieved, and a secondary harder to reach target X down in the 46.5 zone. Now, target X seems to be out of reach right now as the market is making a good effort to consolidate at that 38.2% Fibonacci line at 48.95, as it had previously done in early November and late September. There is one, maybe 1.5 further features I'd like to discuss, both of which I mentioned last week. The first one I wish to retire, and is the idea of a double bottom, which I think I dealt with in depth last week. And the second is an alternate pattern I spoke about, a mid-November 2-day double top pattern. This all depended, as I said last week, and I quote, on not only multiple consecutive closes below the bright red lower trend line, but also below the gold long moving average and the late November low at 49.78. End of quote. I also added at the time, and I quote, "It is too early to confirm this pattern, but as I said about another pattern here, I can give some potentials." Thus, on confirmed breaks low, we would have a primary potential down in the 46.56 zone and a secondary harder to potential down in the 44.64 zone. End of quote. Now, normally I would now formalize those potentials into targets, but I have given the double top some extra study, and I think these potentials are too ambitious, and instead would give a primary target X in the 48.09 zone and a secondary target X2 in the 46.61 zone. What this now leaves us with is two targets below, a double one between 46.50 and 46.61, which is an interesting situation, plus the other one that's closer.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.